Hi everyone, thank you all for tuning in. My name is Madi Daleiden, and I'm currently a senior and student analyst in the Applied Investment Management program at Marquette University. Grace McCrae, my junior mentee in the program, is also joining me for this presentation. Today, we will be presenting on CROX Inc., ticker CROX, which is trading at $178.50 as of market close on November 9th, 2021, and has an estimated price target of $219.33, representing a 22.88% upside. To begin, CROX was founded in 2002 and went public in 2006. It is currently headquartered in Broomfield, Colorado. CROX reports wholesale and direct-to-consumer revenues, which contributed to fiscal year 20 revenue equally at 50% each. D2C is further broken down into e-commerce and retail revenue. While products are sold in over 80 countries, there are 5 key markets that altogether make up 75% of total revenue: the US, Japan, China, South Korea, and Germany. The breakdown of revenue by a geographic segment is also included in the pie chart below. Because of its strong fundamentals and exceptional growth story, it is recommended that CROX be added to the AIM Small Cap Equity Fund with a price target of $219.33, which represents an upside of 22.88%. Top and bottom line expansion are framing this growth story, as revenues have grown at a 17% 5-year CAGR, and EPS has grown from a net loss in fiscal year 16 to $7.49 as expected in fiscal year 2021. Revenue and EPS expectations are illustrated in the graph below. It is also important to note that despite its higher returns than the S&P and the specialty retail subsector, CROX is currently trading at a PE discount, as illustrated in the table on the upper right. Of course, undergirding these fundamentals and technicals is CROX's iconic brand that continues to gain valuable recognition and sentiment across markets. Moving into the drivers of this thesis. Driver number 1, E-Clogmerce driving up margins. The shift to digital sales has been substantial and has led to significant margin expansion. Digital sales were first reported in the first quarter of 2019 as 25.4% of total revenue. In the third quarter of 2021, digital sales now make up 36.8% of total revenue. By 2026, digital sales are expected to exceed over 50% of total revenue. As digital sales have been increasing, the need for capital expenditures and other SG&A expenses associated with brick-and-mortar stores have been driving margins up as well. As you can see on this slide, gross margin has grown at a 14% 5-year CAGR, while operating margin has grown at a 54% 5-year CAGR. The long-term operating margin guidance for management is 26%. Driver number 2, collaborations and brand strength make a great pair. From Balenciaga runways to Instagram influencer streetwear to even the red carpet at the Grammys, wearing CROX as a fashion statement is no longer a joke, due to the firm's ability to maintain incredible brand strength and resiliency. Recent collaborations include Justin Bieber's Drew House brand, the Space Jam reboot, and even KFC. Google Trends suggests favorable brand recognition as CROX searches peaked in the second quarter of 2021. CROX also has a stronger social media presence than many of its peers, suggesting that its ability to appeal to younger audiences as well. Finally, driver number 3. If the shoe fits, invest in Asia. CROX is ramping up its investment in the region as a key long-term growth source. South Korea currently makes up over 66% of all APAC stores, but China is now the primary focus in the region as the second largest footwear market in the world, representing an $88.2 billion TAM opportunity. We predict that APAC will make up over 51% of stores by fiscal year 2022, which will represent over 24% of total revenue. While APAC currently has the lowest margins due to debt financing and initial investments, we believe that the newly located Japanese distribution center will ease operational efficiencies and make the long-term goal of a 24% operating margin in APAC achievable. To reach an intrinsic value for CROX, a 5-year DCF model was created. Using a terminal growth rate of 1.5% and a WACC of 7.07%, an intrinsic value of $230.38 was reached. Additionally, a next 12 months PE multiple was calculated using a weighted average peer multiple of 21.55, resulting in a relative value of $205.69. Finally, a next 12 months EV to EBIT multiple was calculated using a weighted average peer value of 15.6, resulting in a price target of $181.45. By weighing these models 70, 15, 15, a price target of $219.33 was reached, representing a 22.88% upside.
So the first risk is that Crocs has been focused increasingly on the clog style shoe, so much so that it has made up for more than 70% of their total revenues in 2020. The risk here is that consumers may get bored of this trend and shift to other brands to fulfill their needs. And continuing on, this introduces risk number 2, which is that there's not a main leader in the footwear market for brand, so any competitor of Crocs may be able to swoop in and gain more interest of consumers at any point in time. And finally, we have the idea that the Crocs stock has been growing very rapidly, nearly 40% in the past month, which can introduce the idea among some investors that there is speculative behavior going on around the Crocs stock. So in terms of the management at Crocs, Andrew Rees is the current CEO as well as a member on the board. And prior to working at Crocs, he was actually a consultant at LEK Consulting, where he worked with Crocs as they were one of his clients. So in 2014, when Rees joined Crocs, it was a smooth transition. He knew the business model of Crocs, and he was actually able to more quickly help them get out of the lull and bring Crocs back. So he did this by implementing some new marketing and operational strategies, one of which was focusing on the clog in that one line of business. So in terms of the management and board that he works with today, you can see on the slide some of the brands that management previously has worked at, and all of these brands are very well known and established, which really makes for a strong board of directors and management team that Andrew Rees is a part of and works with.
Thank you again for taking the time to review our presentation. We look forward to answering any remaining questions on the D2L discussion board, via email, or during the live Q&A session this Friday. Thanks again and have a great rest of your day.